We always look forward to Mike on the Money. Mike Giordano, financial advisor with Williams Wealth Management. Always great to see you.
Same, Jane.
Markets are hot right now. That third quarter just wrapped up. We'll turn to that in just a second. But first, so many people have had so many issues with Hurricane Helene. It just had such a deep, broad impact on people in our area, Mike. Are there some things that we can do to shore up smaller investments, to financially prepare for future emergencies?
Yeah, absolutely. I mean, some things what you saw up there in Western North Carolina are just so catastrophic that it's really hard to even conceptually prepare for things of that nature. Yeah, but for a lot of people that had some damage or whatever, I mean, I know I joked to my wife, I'd rather be a renter right now after, even just little minor things that you're not expecting. So one of the things that you have to think about, whether it's Helene or just, owning assets in general, a home, whatnot, is that there is going to be some maintenance costs along the way. And the general guideline is expect to pay 1 to 3% every year in repair costs in your home. So if you have a $500,000 home, you're expecting anywhere between $5,000 and $15,000 a year, right? But as we all know, sometimes the air conditioner blows, sometimes you need a new roof, so that thing can be much higher than 3%. So if you just factor that in, that can add a little bit to your emergency savings. So of course you want to keep 3 to 6 months worth of your normal living expenses, and then maybe a little bit extra there for those repairs.
Excellent. Great advice. And then now's the time to think about that.
Right.
Okay, so much is going on in the world right now. Wars overseas. We've got a presidential election less than 3 weeks away. How do we not get distracted from those long-term investment goals with all this going on?
You got to think real far down the road. And it's hard because there's noise all the time.
That's why it's called long-term, though.
Without doubt. I mean, you're a Clemson fan. I mean, what happened after Clemson lost to Georgia? I mean, in the moment, people are like, the game's past Dabo Swinney by. He's not a good coach anymore. All this craziness that I was reading, right?
But we all knew better.
Yes. But you look at his history. He's won national championships. They won 5 straight since then. And so you have to look past the moment, because in the moment there's always noise. There's always something to be fretting about, whether it's world wars or cold wars or trade wars. And so if you look at the long history, the market has done well. It's powered through all those things. So as long as the economic system in the U.S. is still continuing to function, things should be fine.
Yeah, and that's terrific because Clemson fans did not lose heart after that loss.
That's right.
Great analogy right there. Okay, stock market right now at an all-time high.
Yeah.
It looks fantastic. The third quarter's just ended. You call that the earnings season.
Yes.
How does that report, though, set up expectations for what's ahead?
Yeah, so every quarter, publicly traded companies have to report to their shareholders how they did. So they tell you how they did in the last quarter, then they try to prep you for what they think is going to happen over the next quarter, the next year, right? And so for this entire time when the Fed had rates really high, people were expecting, oh my gosh, corporate earnings are going to fall apart, but they didn't. And so now we're trying to see, like, now that they're starting to cut rates, how's that affecting? So far, all we've really heard from is the banks. The banks are great, though, because they not only talk about their own business, but they talk about the economy at large. And so far, they say that the economy seems to be holding up reasonably well. So that's a good thing. We'll get all those tech companies later. So it's hard to really project further out in terms of how the all companies are going to do.
Love that, though. You see any yellow flashing caution lights anywhere?
The biggest issue sometimes is that the economy, the markets can move faster than the economy. So the economy is chugging along here, it's doing fine, but the markets can really take off on it. And from our seat, we're financial planners, we're also evaluating assets, we're asset managers. So you're always trying to think about how do you get value. And so in this type of situation, we advocate for balance, which means if you're like a 55-mile-an-hour driver, you're nice and balanced. This is not when you want to channel Sammy Hagar. Remember, he can't drive 55. You don't want to start going 65, 75 if your general lane is 55 miles an hour. So this, based on where pricing is, you basically want to stay in a neutral stance.
Don't get excited about these big numbers on the Wall Street every day.
Yeah.
Mike Giordano, it's always great to have you with us. Thank you so much.